Does inflation go low? Do we have deflation? Does it go worse? Do we have the negative GDP growth and a legitimate recession? Do things get worse?
And do we immediately cut back to zero?
That would be insane. That would be nuts. Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
Okay, welcome back, everybody. Today we are diving into the official Fed rate cut meeting recap. So it's finally here, and the Fed did cut by 50 basis points or 0.5% on the Fed funds rate. Huge news, but there's some data that we want to dive into and share with you, trying to kind of pick this apart and help you understand at a deeper level what this means for the market, for mortgages, and the decisions you're probably making. So, Ryan, dive into just the basic beginning bullet points of kind of what we're reading between the lines here on.
Yeah. So I want to start off by talking about the decision in general. I mean, what was it, the day before? Odds went from majority voting for 25 basis point cut up to 50 the day before. I think it shifted to...
The odds flipped.
Exactly.
Within the couple of days.
Literally.
It went from
leading up to it.
It went from 1/3 voting for 50 basis point cut and 2/3 for 25 basis point cut to 1/3 for 25 bips and 2/3 for
right. So
for
it flip-flopped, which, who knows, whistleblower, we don't really know why it flipped.
Probably a leak of information.
Yeah,
that
for
happens.
Sure. So regardless, with the decision they made, then this may be speculative. But we've been saying this, I mean, since they started cutting, that they might have pushed the limit a little too far, and they might actually be starting to realize that they waited too long to act. And that's why they made such a large cut in this first decision, because they feel they're a little bit behind the curve. Whether that's speculatory or not, we probably think it isn't. I mean, we know they've been behind for a long time now. That's
what we think. And we'll dive into some additional details as to why there's not any certainty on this, but to help you understand why we think they're behind the curve. So the Fed increased Fed funds rates by 5.375% over a pretty short period of time. Historically, a historic pace of Fed rate increases this time around. They've never increased Fed funds rates this quickly. They did that for obvious reasons. We had inflation that was roaring rampant, and we couldn't get a hold of it. So they had to really tighten down the bolts on the economy. It worked. Inflation's coming down, but inflation has been coming down for quite a while. And even Jerome Powell at the, not this most recent Fed meeting, but the previous one, I think it might have been the Jackson Hole meeting, mentioned that the idea that inflation was transitory, they weren't wrong on that. So they thought it was transitory, then said, oh crap, we were wrong, it's not transitory. And then they're coming back around saying, we actually think it probably was transitory. It just stayed longer than we expected it to be. So it was a longer version of transitory inflation. That is concerning because we saw inflation go down from like 9% to we're now below 3%. Well, Fed funds rates were at, up until just this week, when they made the first cut, the Fed funds rate stayed the same from when it was at 9 to when it was below 3. So when inflation drops by 75%, or 70%, inflation drops by 70%, and the Fed funds rate stays the same, that means the negative impact on the Fed fund rate being as high as it was, the negative draw on the economy is literally 3 times as damning on the economy.
Well, and they've even said it themselves that it takes a long time, sometimes years, for these decisions to actually trickle into the economy like it's supposed to with their monetary policy. They believe that. We know that. So
we believe they're behind the curve.
Exactly. So if that's the case, we have many, many months where we're still going to be feeling the higher interest rate, even though they just cut. because it takes time for that to trickle into the economy,
Based on
which is why we're
historical-
starting to see employment go up, which we don't think it's the end.
Based on historical data, they said that we weren't even going to feel the full effects of the Fed rate cuts until this month, September 2024.
Exactly.
We haven't
2
even
years
felt
later.
the full effect. And that means that we're not going to even feel the effect of this Fed rate hikes. Sorry, Fed rate hikes, we haven't felt the full effect until now. And like you said, a year and a half, 2 years later.
And it's getting ugly now.
Yeah, and it has been. And now the first Fed rate cut just hit. We're not even going to feel the benefit of that for months and months down the road.
Right. So if unemployment's on its route to, high fours, maybe, who knows, low fives at some point, that's really, I would say, inevitable.
Yeah.
With the ripple effect that it's going to cause for the next several months.
And the Fed has to be careful. So, like, one thing we said, they're possibly behind the curve. They didn't outright admit that. And what I wrote down here was their sentiment was that we have a strong economy and they're fully in control of the
They might accomplish a
economy.
soft landing.
Exactly. They're going to accomplish this soft landing. I personally believe, and this is echoed by several other people, other economists and people that track the market closely, I think that's them just trying to be confident and trying to be what economists call hawkish in their commentary to not freak the markets out, because it's essentially a self-fulfilling prophecy. If they say we're in trouble, immediately we're in a recession, instantaneously. So like the sentiment is not really matching the extremity of the cut,
Right.
and the fact that everything's good, we're totally strong, we have no concerns, we're totally in control.
Well, that's why we've always said the decision itself does not carry 100% of the weight. It's mainly the commentary that follows.
Yep.
But they haven't correlated really ever.
Right. None of it makes sense.
Until it's too late, and then it's going to be trying to really kind of backpedal. And
we might already be there.
Yeah,
Like,
for sure.
Unemployment keeps going up, and the data we keep getting is unemployment's actually worse than what we think it is, because the data keeps getting revised worse and worse and worse and worse and worse every single time. Well,
Literally every month.
unemployment is a massive. That's literally, they have a dual mandate. Dual mandate is prices for American households and employment for American households, and they need to keep these two things in balance. Well, we don't even know if unemployment's in balance because we don't even have the real data, and we're a year behind on some of these revisions.
Yeah.
Remember, the last revision was 818,000 jobs they
Over
said were created were not
30%.
created.
Yeah.
Like,
Right.
That's insane.
Still so much data to unfold.
It is wild. So now let's go into economic projections. The SEP is what you call it, Summary of Economic Projections from the Fed leaders. They give some information. Let's dive into that.
Yeah, so we'll start off with just the decisions in general. They're forecasting another 50 basis points of additional cuts this year, so in 2024. And then next year, they're anticipating another 100 basis points. So that would put us where? Somewhere in the 3% range for Fed rate.
Yeah, I think
at
like
the end
3.25.
At the end of 2025.
Yeah.
So that's as far as decision making goes. Now, as far as progress on inflation, they actually don't anticipate to get to their 2% target which is again the other side of the dual mandate that you just mentioned, until 2026. Which again I think just points back to the full ripple of these decisions that were made over the last 2 years. So
And they never thought it would get as high as it got. It got way higher. That's the crazy thing, is everything they've said historically, and even this economic cycle, they've practically been wrong about 100% of it, and it's been worse than they expected. So our fear is that it could be worse than they expect coming on the other side, right? Inflation went higher than they expected, faster than they expected, for longer than they expected. So does inflation go low? Do we have deflation? Does it go worse? Do we have negative GDP growth and a legitimate recession? Do things get worse?
And do we
than they
immediately
expect?
cut back to zero?
That would be insane. That would be nuts. The nice thing is they can have an impact without having to go all the way to zero. They can have a significant impact because rates are so high.
Right.
So we have a bigger parachute. But a couple things in the economic projections that I pulled out of that I was shocked by is the summary of economic projections from the last update in June to this September one is they increased the the Fed participant, the voting members, increased their expectation of the unemployment rate. So in other words, the unemployment rate, what they thought would be the terminal high rate or the highest point of unemployment percentage, that increased by, I think, it was either 20 or 40 basis points. I think it went from 4.1 or maybe 4.3 up to 4.5. So they're saying, hey, employment's probably going to be a little worse than we expected just a few months ago. But also, Fed rate cuts into the future. They expect more Fed rate cuts moving into the future. So not only do they expect the unemployment situation, in other words, the economy, to be worse, they also expect to keep that in check. They have to cut more than they expected. So they're already seeing this writing on the wall that things could be worse. And then in addition, GDP growth, they reduced. I think it went from an anticipated 1.9%. I believe this was in 2025. I wish I would have grabbed this data before this, but I believe it was 2025. It went from 1.9% to the most current projections were 1.3%. So on all accounts, the Fed members believe the economy is going to be worse and they're going to have to cut more than they originally or than they most recently expected back in June just to keep the wheels on the bus. Like, they're behind the flipping curve and they just don't want to admit it.
Again, going back to commentary, just like you said, they don't want to admit it. They're always going to say, it's always the but statements, right? Like, they make the decision, but we're not worried about it getting worse. Like, it looks like, let's see, Powell mentioned that the market should not get used to this pace of 50 basis point cuts, and they're not committing to that amount going forward. This was just to ensure that they don't fall behind. So starting with 50 purely was just to make sure they don't fall behind.
Basically, a kill shot is how they're explaining it. They didn't just want to, give a little slice to slow it down. They just wanted to kill it. And it's like, it's not going to happen that way. It didn't happen that way when they increased like crazy. Now, one thing, just as a little note, you should all be watching. If the unemployment rate gets published and it goes above 4.5, that is going to be a good signal. The Fed's going to cut much more aggressively than they expected. And the reality is, based on history, when the SAHM rule takes effect, you can look that up, SAHM rule. When that takes effect, where the unemployment has risen a certain percentage over a certain period of time from its low point to its current high point, then it likely is going to rise even further by a significant measure.
It's the guarantee recession button.
Really. Basically, yeah, it's never been wrong.
Yeah.
But we're at 4.3 today. The SAHM rule is in effect. They're saying we don't think we're going to get above 4.5. Historically speaking, I believe, and you can't quote me on this exactly. We could look up this data if you're really curious. But just conceptually, the idea here is, historically, when this has taken effect, the unemployment has gone up somewhere between 1% and 2% higher beyond the trigger of the SAHM rule. Mm-hmm. So that means that we could be north of 5%, maybe nearing 5.5%, and they think we're only going to get to 4.5%.
Yeah.
To your point, that could create massive cuts.
A good way to maybe even close this up too is, how does this correlate to mortgage rates? Mm-hmm. We didn't see a huge improvement on Wednesday when they made the decision.
In fact, rates got
why?
worse.
It's because we just discussed there's conflicting opinions. The markets don't even know what to think right now. Because yes, they did cut 50 basis points. That is technically a turn in the right direction, but they don't know what to expect going forward. If we continue to see weaker job data and higher unemployment, then yeah, we're going to continue to see mortgage rates to fall. But that's going to take some time. And so realistically, it's not going to be 7% mortgage rates to 5% in 2 months. Right. Like, we're still going to see the trickle effect of the volatility, the up and down, which is still the downward trend that we're seeing. But
it is a downward trend, but it's not going to be a cliff.
No, exactly. Yeah. So I think we still have room to go, or a fair amount of time that's going to pass for mortgage rates to get into the range that a lot of people are hoping for, down to the 5s.
Yep.
Majority.
Yep. Yeah, I agree. And a couple things I wrote down was like, this is my own total opinion, conjecture. There's no real fact to this, but they cut 50 basis points to basically appease the markets, because the markets were betting on it. And if they hadn't done that, it would have been bad for the markets in general. Yeah. They cut 50 basis points, or a half a point, but they give this commentary like everything's totally good. We're giving you some insight as to why we think it's not totally good. And this is all just based on statistics and history. This is not based on like our own personal opinion. But are they doing this in an effort to not impact the election that's coming up. The election is 45 days away, approximately.
Yeah.
Like, they need to be cautious.
I mean, that throws a whole nother aspect to this.
For sure. And is it intentionally political? Is it intentionally trying to not be political and stay neutral? Like, there's a lot of play there in that as well. So I think after the election, we also start seeing
a lot
much
more clarity.
Clear picture of what's going on.
Ton more clarity.
Fed
all
maybe
of a sudden,
now
like,
admits there's a recession.
oh, we missed all of this that was happening over the last 2 years.
Yeah,
Sorry, but this is actually what's going on.
Yep. And I guess I'll end with this, and then if you've got any final thoughts, this is kind of just pigtailing off of what you said, and it's the mortgage rates. Lots of people think that when when the Fed funds rate changes, mortgage rates change, and that just is not the case. That impacts directly consumer debt, credit cards, HELOCs, different lines of credit, auto loans, those types of things. Those are impacted directly by the Fed funds rate change. Mortgage rates are not. Mortgage rates are impacted by a mortgage-backed security, which is a publicly traded asset. A publicly traded asset, just like the S&P 500 or any other stock, Tesla stock, doesn't matter. The way traders or the market in general make money is by forecasting what's going to happen, placing bets ahead of that happening, and then the bet that they placed comes to fruition and they make a profit. That is how the mortgage rates work. So we saw, and we communicated this to many of our clients, we saw the rates the improvements were already baked in a week before the Fed rate cuts. Now we have, in that week we did see some improvements because of the flop to the higher cut, but it was already baked in. So the actual impact is not the case. So now going into future rate cuts, you have to really focus on what is the tone of Jerome Powell? What is the sentiment of the commentary from all of the Fed? What are they saying? Are they getting nervous? Are they continuing to flex their muscle? The Fed has to pay attention to this because they're essentially now in a position where they have to make bets now on what is the next rate cut. Because Jerome already said, don't count on 50 bips. So it's going to create this volatility where we're not going to have a straight line because the markets have to make bets on unclear information. But hopefully after the election, it gets more clear.
Unemployment is what you should be following because that's going to be, I guess the job numbers and the revisions will affect that. But unemployment, guarantee you if that keeps going up, you're going to see mortgage rates come down. That's going to impact it more than the Fed's actual decision of rate cuts. So pay attention to that. And then also something I'll just throw out here to wrap this up. Cash or the dollar is going to become less and less valuable as they start to make these decisions to cut interest rates. So buy assets.
Yeah, 100%. Buy real estate.
Yeah, exactly.
Yeah, for sure. Cool. Well, thank you all for tuning in. Hopefully this was valuable. If you have any questions or there's specific details that you feel like we missed that we should elaborate on, please comment on the video. Be sure to like, subscribe, do all the things, share with your friends. But thanks for tuning in. We'll catch you next time.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.